So the Fed cut the Fed funds rate yesterday by 25 basis points, which was expected. But there are a couple of things in Jerome Powell's speech from yesterday that I think are worth taking a deeper dive into. So without further ado, let's just jump right in. So here is a transcript from Jerome Powell's speech yesterday. What's funny about this is a lot of this is copied and pasted from last month's speech. The reason for that is there's really not a ton of new data for them to go off of because of the government shutdown. So there are risks to the labor force to the downside. There are risks of inflation going to the upside. That hasn't changed. It's still uncertain how tariffs are going to impact inflation. So all of that basically the same. We don't have a ton of new data to go off of. But they did cut by a quarter of a percentage point. They also have ended their quantitative tightening cycles. So basically, what that is the Fed allows assets as they mature to fall off of their balance sheet without reinvesting that capital into the market. And what that does is basically it burns money or eliminates it from the pool of money that is outstanding. So the goal is to reduce the overall money supply. I'll show you a chart after this that shows just how much money supply increased after COVID and how they've tried to reduce their balance sheet since then. So I won't get into GDP. I made a separate video about that. Check it out if you want to learn more about how GDP has been weird this year. Unemployment is still low. Layoffs and hiring remain low, both layoffs and hiring. But if you look at 2024 job cuts, there was about 761,000 for the full year, and we're projecting over a million of job cuts for 2025. So that's like a 25% increase in job cuts. So not an insignificant number, but I don't think anything that's sounding the alarm bells. Inflation elevated, nothing new there. Um, So they're continuing to move towards a neutral policy stance. But this is one of the key takeaways from the speech right here. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Basically, I think the market was expecting it was above 90% likelihood that there would be a cut in December. That percentage is now around 67%. So there's clearly some uncertainty that there's going to be a cut in December. I think that there's still a pretty good chance that there's a cut, but without data, Powell isn't willing to commit to that cut. If we see the labor market weakening significantly between now and December, there will be a cut. But without that data, you can't make that decision. So yeah, the only other thing I'll point out here is he talks a little bit about they've reduced the balance sheet of the Fed by 2.2 trillion. Seems like a lot of money, right? But I'll show you the chart that shows that compared to pre-COVID, their balance sheet is still significantly higher. And then the other thing here is they're going to allow agency securities to run off the balance sheet and reinvest those into treasury bills. So while they're not starting a full quantitative easing cycle where they're printing money and injecting it into the market, they are allowing like mortgage backed securities to run off of the balance sheet, taking that cash and investing it into T bills, which is going to prop up that market a little bit. So it's quantitative easing light, where they're not propping up the full market, but they are targeting T bills. So really quickly, here is a chart of the Fed's balance sheet assets. So basically, this is how much they hold in mortgage-backed securities, treasuries, other investments on the balance sheet. You'll see that there's a massive spike as they print money to prop up the market during COVID. You go from an average of around 4.5 for 5-ish years with a drop there all the way up to around 9 million. So basically they doubled the assets on the Fed's balance sheet. So yes, they cut 2.2 trillion, but you'll see they're at 6.7 trillion right now. Compared to the 4.5 trillion that they were. So that's the result of quantitative tightening. That's what that does, is it reduces the assets. So they made a little bit of a dent, but nowhere near where they were prior to COVID. So that's what I have for you. 25 basis point cut. the end of quantitative tightening for this cycle, with quantitative easing light, and some uncertainty about whether they're going to cut in December or not. So we'll know more as we get more data in the coming months. But as I mentioned in the body of this video, I have a couple of other videos going into GDP and things like that. So if you want to check those out, please do. But thanks for watching and have a great day.